plenary session on monetising socio-environmental impacts toward an international convergence, advances and challenges. And we have here at the table Mario Bella and Peter Luan. It is a very interesting debate, and the premise is about opposing position or converging position. But basically, it comes again at this table, the issue of metrics, how to measure the impact. Here again comes at our attention the focus of many attempts, scholar attempts, but also practical attempts in the fields of monetization of socio-environmental impact. We have to say that the topic is not new. We already are aware that it is being around in the economic and political debate, starting from the second half century of the 90s, so of the 20th century, sorry. And this is why the debate and the question is important. How to measure, but first of all, how to identify the impact, how to describe them, how to measure them, how to evaluate them. It's very hard to establish a common way to look at things, and I say it is a long time that people are debating on these issues, and many methodologies are arising and are opposing sometimes. And I feel like that is the moment to stay at the core of this problem, since I see something changing. Please correct me if I'm wrong, but it's my impression. So what I think that looks like new in this debate, that is coming at our attention, the relevance to make this attempt with the cooperation of companies on one side and auditing firms on the other side. So it comes at our attention the main issues in the general debate about non-financial results. So not only how to measure, how to evaluate, how to monetize results, and which technical tools, so we are debating about double-entry bookkeeping or outside the information, accounting information system, but also to demonstrate to third parties that what is written in an accounts in a model is able to represent the truth. So it can be accepted. So what is the role of accountants and what will be the role of auditors, of auditing firms? And another point that I want to leave to your attention, if you want, find it really interesting, is what is the unit of analysis of our discourse today. So, usually the domain about socio-environmental impact is being mainly of the economic side and not the business side of measurement, okay? So, it is not only, so we have debated also with the previous plenary session about how to identify intangibles and where to put this information in what kind of representation, qualitative versus quantitative, but inside the financial statement or the management commentary in descriptive way. Now we have another challenge. So probably we have to put our view outside the company, because the issue is here also to establish the impact the company are able to produce for external interest. So it is a double perspective that comes. This is on one side of the company that want to know for the decision-making process the impact and want to measure this impact in terms of cost saving or revenues that comes from the investment. And on the other side, we want as a society as a whole to know and to evaluate, to measure the social-environmental impact produced by the companies. So at this table we have two very authoritative exponents of the debate, current debate. And we have Mario Bella, Director of Methodology at the Value Balancing Alliance, and is at the same time a colleague at the Business School of Paris. And this alliance has started a pair of years ago, an experimental foundation of analysis, trying to put in place a new methodologies. I want to leave the floor to Maria Bella, and this is an opportunity to know more about this experience.
Thanks very much, Daniela. And thank you all for being here today, and again for being invited to this conference. I think when we look at this whole arena of impacts and the impacts of business, one of the difficulties is really around definitions. And so there has been a lot of discussion around the impacts companies have on the world outside of them, but there hasn't really been much discussion. I think not until the EIASM introduced this notion of enterprise value have we started to, move the pendulum back to thinking about value to business. So I want to, hopefully you'll indulge me to go through a few ideas here. Can I stand up?
Yeah.
Or can everyone hear me if I stand up? Okay. So there's been this kind of changing discourse. We have the Milton Friedman discourse around, Milton Friedman's view that basically the business of business is business, and companies should focus solely on creating profit and wealth for their shareholders. That discourse is well understood. Then in the 1990s, we started to see these new types of business models. And it's really where the business model literature really started to explode, because previously it was reasonably straightforward what companies did. You didn't have to go into a lot of detail in terms of how they made money. But once we had all these .com companies, and also social media companies, etc., their business model became a lot more difficult to understand. And that really gave rise to a lot of this business model literature, and the narrative changed. So we moved from talking about making money or profitability, and already in this conference, I haven't heard anyone using those terms. Everyone talks about creating value. But then when you say, okay, what is value in the context of business? And there seems to be a lot of confusion, a lot of conflation around, let's kind of soften the language and talk about value creation, because that sounds like something nicer than just making money. And part of the problem is that this notion of value creation is often conflated, looking at it from multiple perspectives. So in terms of the kind of, what's the unit of account, for the purposes of this discussion, or my perspective in the value to business, is looking at this solely from the perspective of the entity itself. Okay, so we're looking at it from the perspective of the entity. And I think part of the problem, and we've talked about it before, I think Janine touched on it this morning in terms of the capitals. We've kind of mushed all these concepts together and they don't quite come out right. So, if you think about the accounting notion of a capital, it includes only those things that the business controls. So the environment is not a capital. So there's all these disconnects, and I think, if we want to get into sociology, some of these terms that we keep using are empty signifiers. And also the point about conflating the capturing of value with the distribution, like who benefits, who gets the value. So to clarify, what do we mean by value? Now, typically in accounting, we only look at this side of things in terms of use value. So we talk about a value in use and a value in exchange. So either there's a value from holding an asset, it's part of our production facilities or whatever they are, or it's inventory, for example, which we hold to exchange. These non-accounting concepts of value, so non-use value, like existence value, Daniela's a fantastic person. She has value just to exist. Even if she does nothing, she's, a valuable human being. Altruistic value in terms of, doing good for others, helping others, and then bequest value. What are we actually passing on to the next generation? So these are really important questions, and these really concern most of our lives. We spend our lives sort of in this arena of trying to be of value to our families, to our friends, to our employers, whoever, and trying to leave the world in kind of better shape. But accounting hasn't been able really to cope with that, and our economic models haven't been very good at coping with that. So, to go back to the future, Bob Eccles, there was a book written called Value Reporting, and only old people like me will remember that book. It was put out by PwC, authored by Bob Eccles and others. And interestingly, Bob made this comment in the book that managing for value calls on companies to report information on the financial measures they believe correlate most closely with shareholder value. So it's an idea that has been sort of ingrained and around for a long time. And in case you don't know these two people, that's Milton Friedman and that's Ed Friedman, not Karl Marx. And Ed Friedman has espoused for many, many years this concept of stakeholder value, stakeholder theory, and I want to pick up on that as we move through. And there was this proverb that I found: the beginning of wisdom is to call things by their right names. So I think the Chinese were completely right when they came up with that proverb. So one thing we need to think about is that when we're talking about creating value, McKinsey did this study back in 2015, which was a super interesting piece of work. And it shows that the global profit pools are drying up. So the sort of exponential growth we've seen in profitability of corporations has reached its zenith and now is starting to fall. So there is less profit to go around, which is a kind of, there's a lot of discussion at the moment around degrowth and, moving away from this focus on economic growth. And, part of that narrative is correct in that, the evidence shows that the profit pools are shrinking. So this abundance that we've had is starting to diminish. So again, to clarify concepts. So value to business, what do we mean by value to business? I think what we mean is cash flows. So we mean realised profits. And then the value to society, externalities, that red block there, typically is a loss, and typically it accrues to society. And there is a view, and I think we can prove it, that there's this kind of boomerang effect, that if companies create too much cost or burden on society, those costs will come back to the company in some form. And a lot of this kind of thinking about externalities is based on a very traditional concept of the value chain, Porter's value chain, and this, we take inputs, we transform them through some sort of process, and there are outputs. And the outputs are cash, and that cash is distributed to the stakeholders in the business, employees, shareholders, etc. And then there's externalities. And often, if you want to talk about production possibility frontiers, companies are able to use these externalities to effectively subsidise their profits. Because what they're doing is, through externalities, is you're pushing the cost to somebody else. So that's just kind of basic economic theory. So to illustrate what I mean here, food and agriculture. The global food industry is worth around 10 trillion US dollars. So all the companies involved in food and agriculture. When we look at externalities, so we look at things like obesity, we look at greenhouse gas emissions, we look at all these other externalities that are not counted, this seemingly very profitable sector of our economy leads to a negative 2 trillion. So all of this, when we take into account all these externalities, we end up in a deficit situation. So we have all these perversities like we have communities suffering from undernutrition, and then in other parts of the world, effectively overnutrition and obesity. So we have all these paradoxes and all these costs that are being borne by others, but not by those businesses. So we need to start thinking about this in a much more holistic way, and that's why the Value Balancing Alliance will talk about impacts, and our colleagues at Harvard as well, as saying you can't ignore these costs because somebody has to address those. So these health costs, the blue ones are health costs. Well, that cost is being borne by our healthcare systems. And whether you're in Italy, France, UK, US, health systems, the cost of health systems is increasing exponentially. And it's one of the line items for governments that is really difficult to manage. So we keep talking about this wonderful chart from Ocean Tomo about how 90% of the value of a company, its enterprise value, is intangible. It's not in the balance sheet. So, according to their latest study, only 10%. So the balance sheet's only capturing 10%. Now, these are averages, and it may not be that for every single industry. So just to remind you, what is an asset? So, have to have economic benefits, has to be controlled by the entity, and has to result from a past transaction. So that's kind of well understood, and we have accounting standards, and we have this very peculiar system where some intangibles are recognised because we have a transaction, and some intangibles are not recognised, unless you're in oil and gas, in which case you can capitalise everything. There's all these kind of weird and wonderful things we do with our accounting. But it's clear in company law that value equals cash. That's been a kind of, or the prospect of cash. I mean, that is kind of a fundamental building block of economics. And intangibles, if you think about what's the value of an intangible, it's the net present value of future cash flows. So, there's nothing radical here. And so if we're looking at, well, what are the total assets of a business, we need to think about tangible assets and also intangible assets. So we need to move the accounting on to start capturing the other part of the balance sheet. And that may mean that you're also going to start collecting some of these costs. So what you might think of as a kind of negative intangible through this kind of rebound effect that we talk about. Now, I don't want to confuse you too much, but in fact all assets are intangible. So if you go to the Conceptual Framework, all assets, they're bundles of economic benefits. That's why a leased car and a car that you own are no different, because they're just bundles of services. So this whole preoccupation we have with, the tangibility of assets, I think we've got to kind of move beyond. And I think enterprise value is something we still have to explore. I think the definition the ISSB's come up with is a partial definition, and I'll explain what I mean by that in my next slide. So, as I mentioned this morning, double materiality is not a financial reporting concept, but I think double materiality applies to the business model. And if your business model isn't looking at both inside out and outside in impacts, then you're not capturing all the risks and opportunities of your business model. So what do I mean? So, this is a kind of more holistic way to think about your business model. And there's a lot of academic literature, Zott and Ahmed and others that kind of supports this, that says, well, where is value created? Where should we be looking at? And what we should be looking at, they say, and other people are saying, is we should look at the relationships between the business and its stakeholders. It's in those relationships that value is created. Now that shouldn't be a mind-blowing concept, because if you think about it, if a company has a really good relationship with its customers, that is going to make that customer loyal to that company instead of its competitor. So, same with employees. Treat your employees badly, it works in the short term, but over the sort of medium longer term, you'll have high recruitment costs, you'll probably have to pay higher salaries, etc., etc. So, this is a kind of different way of thinking about business models, but I think it's really important. And I think from if we want to start thinking about, well, how do we measure these intangibles? It's measuring the quality of these relationships. So what's the quality of your relationship with your customers? What's the quality of your relationship with the environment? Do you just take from the environment, you don't remediate? What's the quality of your relationship with your employees? So understanding the quality of these relationships, I would argue, is absolutely key in understanding the value creation process of a business. And I think it's important to separate out, because often we conflate a lot of these concepts. So it's important to separate out the creation of value. So in the business model literature, this is all made very clear, but we need to separate out value creation from value capture. So you can create value, but you may not capture all of it. And in fact, competitors will, through competition, will erode the amount of value that you're able to capture. And then also, who gets the benefit? Because often when we start talking about impacts, we're conflating this notion of distribution. Okay, so first of all, how do we make money? And then who gets that money? And I think when we're having conversations about impact, we're really at this level of distribution. And then finally, and this is kind of sort of newer thinking around attribution. So if there are costs, like the plastic island in the Pacific, that's three times the size of France, who do we attribute the cost of that? Do we say to Coca-Cola, well, a lot of that plastic looks like your bottles, so therefore we attribute some of that cost to them? Actually, a lot of it is fishing nets. So at Wiki, we've actually done a lot of work looking at, so these are just some of the metrics you could use on human capital in terms of, well, what is it? You know, if we want to be really kind of concrete and pragmatic here, and this is available on our website when our website gets fixed. But you can see these are qualitative. A lot of these things are qualitative. So how good are we at attracting talent? You know, to what extent are we addressing the glass ceiling? So if I'm a woman working in a company, do I feel like I have the same opportunities as my male colleagues? Or if I come from a different ethnic group, do I have the same opportunities? You know, if I'm lesbian or gay, do I have the same opportunities? And we know that companies that are addressing these issues and providing more opportunities have much more loyal staff, much more productive staff. So at Wiki, this is just one example. This is for the beverage sector. We've developed a whole lot of these KPIs for different sectors. And this is just looking at human capital. So, in terms of, so how do we measure impact? Which is kind of, it's taken me a long time, I know, to get to this point. But if we take company A, we take, this is how we measure impact. We take something like carbon emissions. We have quite complicated formulas for how we actually calculate the amount of carbon that our business has created. We then multiply it by a coefficient, like the social cost of capital, the social cost of carbon, to arrive at cost. And that cost is what some companies are starting to report in their, usually in a separate impact report that they're preparing. And, you know, where does that go? That's somehow captured in the reputation of the company, in the intangibles. If we look at stakeholder one here is the environment. So if the impact is biodiversity loss, so for those accountants in the room, you could say that the first approach, the cost approach of measuring impacts, is an exit price. It's like, how much would I have to pay to kind of get out of this? Whereas if we were to go for an entry price, so how much would it cost to actually fix the damage that I've done? You know, so it's great to say, yeah, we've emitted so many tons of carbon at X cost, which comes to whatever, a very large number. But what does that mean? And what do we do with that information? So, just to take you through very quickly the methodology, and this, when it comes to greenhouse gas emissions, the methodology that the crew at Harvard have is pretty much identical to the way we do this. So we look at impact drivers. We then look at what are the impact pathways. So greenhouse gas emissions, you know, lead to things like rising sea temperatures, shifting climate patterns, sea level rises, and more extreme weather events. And then looking at, well, what are all the impacts, and let's aggregate the cost of all those impacts. So if we look at, so what's the change in the Earth's balance sheet? We can measure the change in natural capital by looking at air, water, land and biodiversity and seeing, okay, so when we have these greenhouse gas emissions, what are the final impacts they have on the environment? So this is where we've got to in impact measurement. We tend to measure the cost of the impact. So effectively, if you think about this from a company perspective, you know, for a long time we've been saying one of the big financial risks for a company is their unfunded pension liability. Well, we have a lot of other unfunded liabilities that could crystallise. So there is a huge risk for businesses, particularly those business models that rely very heavily on value extraction. So these are business models that produce a lot of externalities, like fast fashion. Basically, fast fashion only works because people in developing countries are providing labour at a below market price, so that the retailer in Italy or in the UK or wherever they are can make an acceptable margin. It means someone else is subsidising through those externalities. So how do we move forward with all of this? So and you know, one of the things that we're finding with companies that are measuring impact at the Value Balancing Alliance is that we've become very good at measuring every single impact we can identify, and we do it in a very scientific way. And now companies are saying, okay, but what do we do with the information? How do we include that information in decision making? Yeah, it's great, we can measure everything, and a lot of companies do, and do a great job of it, but it's like, so what? You know, how does this inform decision making? And I just want to just finish on this point of the alternative would be to think about, well, what's the cost of the solution? So on greenhouse gas emissions, you can measure the cost of people having to buy air purifiers because the air in their apartments is not good because the air outside is polluted, etc. The alternative would be to clean the air in the first place and not have so many emissions. So that's the point here about the solution and who pays for that solution. And this really interesting chart comes from Planet Tracker. And what Planet Tracker have done is, if you look at the fishing industry, the blue bars represent the increasing cost on fishing companies to catch a fish. So to catch fish, companies are having to go to new areas where there are still fish stocks. But what's going to happen soon is it's going to become, because the fish stocks are depleting, we'll soon be in a position where the costs will be so high that those companies won't be making any money, and that will be sustained, because then the fish stocks will collapse. Now the alternative, and this is a way we need to start thinking, is if we just reduce by 10% the amount of fish that we take out of the oceans every year, that would give the fish stocks enough time to recover, and then we see, okay, so you're going to suffer kind of lower revenues for a period and lower margin, free cash flows, but then it's increasing, and it increases in a kind of sustainable pattern over time. So this is how we need to start rethinking some of our business models. The first one just assumes, which is what we teach our accounting students, that, you know, basically it's business as usual. You don't factor all this stuff in. But actually we need to start thinking, okay, what's a recovery scenario look like? And, you know, maybe we do have to agree and get regulators to say, okay, less fishing to let the stocks recover, which will then lead to a more sustainable and profitable business model, which at the end of the day, it's not a business model if it doesn't generate profit. I can't explain Tesla, but thank you.
Interesting presentation, and you in some way answered my question. So, especially with the last suggestion, what we do with this measure, how we can monetize it, the first point, but basically the aim is to understand what to do with this measure. And if something has to change, if the market is not perfect, and we can regulate the market in order to maintain what is the aim of the company, to find out cash flows and profits, we have to establish new rules, and to govern this process we have to measure. It's very interesting. Thank you so much.
Thank you.
Now,
can I just make a point on that?
Yeah.
I mean, one of the things that we're finding with monetization is that unlike accounting numbers, they're not additive. So you can't actually add them together because they're developed on a different basis. So there are some issues. But anyway, sorry.
Yes, thank you so much. First, before continuing, just a brief, let me say, if you want to go to the Greek theater, we have to move in about 30 minutes, not more. So if you want to change your shoes to be more comfortable when walking within the theater, you can try. And I ask you to go immediately in the direction of the Greek theater. We will provide, if possible, a list of people who have to come here, because we have to pay before, so that there are some practicalities. And since the Greek theater is going to close at 7, so we have very few minutes to stay here. So let's try, okay? It's a challenge, okay? Now is the time of Eden Ruan. Eden Ruan comes from, is a professor of business administration in accounting and management, and he teaches a very fascinating subject, because if I'm not wrong, it is reimagining capitalism. Is it correct? So I think that is a very ambitious aim with an ethical root to change something in the culture basis and professionalism of people, of young people that is approaching business economics. So he's at the same time co-chair of the impact-weighted account project at the Harvard Business School. Again, a very ambitious ambitions for this project. Since I make a brief comment and give you the floor, because we have very few minutes. The aim, if I'm not wrong again, is to try to find out a way to put into financial accounts the impact weighted. So the ambitious aim is to, first of all, admit that we can measure, then that we should measure, and that we can use this measurement, this monetization, to evaluate the impact, to make decision making. So to translate this information, to find out the usefulness of this information for users. So I'm very curious and interested, and I want to leave you the floor. And I thank you so much for being here, and since you have to do a long travel to come here, so floor is yours.
Thanks, it's my pleasure. I can make it really short and just say I agree with everything Mario says. And we can get a head start on the theater if we'd like. But it's funny, it was a long trip, but I went for a run this morning and I realized that it's this town is kind of a perfect metaphor for what we're talking about today, because I stepped outside and the weather was kind of crappy and I thought about going back in, but I powered through. I went for my run, I ran up a very long hill and hit a dead end, ran back down, ran up another hill, hit another dead end, and I kept hitting these dead ends until finally I found this one never-ending street that provided these beautiful, beautiful views, and I feel like that's what we're trying to do here as well. So I'll spend most of my time just talking about what we're doing at the Impact-Weighted Accounts Initiative, which is, we have similar goals, but a slightly different approach. So we think about, our goal is to monetize non-financial impact in a way that can be brought into the financial statements. And Janine mentioned today this goal of, a new valuation model, and I think this is a step toward that. If we're gonna have a new valuation model, we either need to change the language of the financials or the language of impact. And the language of the financials, we're so grounded there, and the decision makers here are so grounded in that language that it's better to translate what we're doing into their language. To do this, we think about impact along 3 dimensions. It's the environment, employees, and products, customers. And we basically do, Mary walked us through what basically we try to do. We think on the environmental side, it's the resources that firms consume and the emissions that they put out into the environment. On the employment side, we think about it in terms of the opportunities they provide to employees. Think about it along the diversity dimensions, think about it in terms of promotion, pay throughout the organization. Product is a much bigger challenge just because it's so idiosyncratic. But again, I like to use a car as a great example of how we think about the impact of our product. The first step is it available? Is it affordable? The second is, when I buy it, do I have to repair it all the time? What are the carbon emissions it gets? Is it reliable? And then when I'm done with it, how easy is it to recycle? What happens to the product once it's no longer useful? And we've taken a bunch of steps to do some analysis on whether our methodology works. And I'm saying this is a plug because we have some data sets that we provide free to academic researchers if you're interested in doing this. So on the environmental side, which again, our methodology and our implementation is by far the farthest advanced, in part because the data are readily available, we find, importantly, significant heterogeneity in the environmental impact of firms. To give you an example, in oil and gas, using our methodology, if Exxon were to properly price its environmental impact, it would wipe out 73% of its profits. Shell, which is a pretty similar company, it would only be 25%. So you can start to see that there is variation. When we looked at about 2,500 public companies across the globe, we find that those with lower negative environmental impact have higher valuations and lower volatility. On the employment side, we've actually been very lucky. We've stumbled across an excellent data set that provides pretty detailed information on publicly traded firms. Again, we're able to apply this methodology. We find similar heterogeneity. Actually, one industry we looked at is the hotel industry. And there's huge, you think of it as just everybody's treating everybody the same, but that's really not the case in terms of what they're paying their employees and the opportunities they're providing their employees. Coming back to this large data set that we have, it's about 2,000 US-based companies. Here we find that firms that have more positive employment impact also have lower turnover and greater valuations. And so you can see that we can work this into our financial statements because there are both positive and negative impacts here. It's very much like a P&L. Lastly, on the product side, as I said, we're doing it in a somewhat bespoke model. So we looked at the auto industry and we find that a company like Toyota, this was back in 2019 when we did this analysis, Toyota had huge positive product impact. The leader in hybrid and electric vehicles. On the other side, we saw Ford and GM at the very bottom. Their products cause more harm than good in the environment, but this was, again, before they were even taking that step toward EVs. But you can see that this is actually, this is evidence that it's affecting decision making, because now Ford and GM are really making a huge push toward EVs. They're realizing that this product impact matters to consumers. I have a paper coming out, I'll give a plug for it's called Accounting for a Sustainable World Quarterly. It's a new journal put out by Peter Easton at Notre Dame. They're trying to look at, they're trying to encourage academics and practitioners to write serious articles about these issues. And so we did a product analysis of the Fintech space, which was very interesting because we didn't find much. And by that I mean, Fintech receives more impact investment dollars than any other industry. And they do it arguing that, hey, we're bringing financial inclusion, cybersecurity. Those are the two big things they're hanging their hats on. MasterCard's a great example. You look at MasterCard's disclosures, it's all about financial inclusion, but very few of these companies are actually disclosing any quantitative information to validate their arguments there. And so in this article we show a few. PayPal's a good example of a company that is actually doing this, and it is measurable, but it's only measurable when we get cooperation from companies. So lastly, I'll just talk briefly about the partnerships we have at Impact-Weighted Accounts. We've worked with academics around the world. We've also worked with a lot of practitioners, and we see the strength of these kinds of methodologies in the willingness to adopt them across diverse stakeholder groups. So we have investors, we have BlackRock's stewardship team using this as a screening tool. We have several private equity firms that have been using it not only as a screening tool, but also to manage their companies, especially on the employment side. They're using this methodology to try to create better opportunities for the employees of the companies in their portfolios. We have numerous companies that are also using it in similar methodologies. Another stakeholder group we've actually found some success with is governance. So we've been partnering, for example, with Fresno, California. It's a big city with a lot of poverty, and they have been trying to incentivize companies to come in through tax incentives and the like many other municipalities do. But very few of them actually have any kind of auditing system to make sure that the companies that promise to employ the citizens, promise to promote women and minorities, there's very little auditing to confirm that they're actually doing that. And so in order to get these tax incentives in Fresno now, they're using the impact-weighted methodology. Lastly, we also have educational materials. So we have cases, we have exercises that can be to teach students to do this, and I'll conclude by talking about my class, Reimagining Capitalism. So this course has been taught at Harvard Business School for more than a decade now, but it's shifted dramatically in the last 3 or 4 years. We've actually, more than half of the content is brand new. And that's because the course started as a course to convince MBA students that firms have an obligation to act on non-financial impact. But the students we're seeing now, they don't need to be sold this argument anymore. They come in believing that firms are more than just the profits they make. And so we are shifting it to a tool-based course. It's basically teaching students, we know that firms need to do this. Now we need to know what the tools are to actually implement, to go in and start on day one to have impact beyond financial gains. So with that, I'll wrap it up. And thank you so much. I tried to be quick. I know I'm eager to see the other side.
It was quick. So, thank you very much. So, a very brief comment. So, just a pair of minutes, let me know. Okay. What about the different position, different work, and how do you imagine this to converge in practice and to involve auditing firms? We have here an exponent, KPMG. You can see that KPMG is a support of these events. That means that also the auditing firms believe in this change and they are investing in this change.
Well, from a cynical point of view, I mean, there's tons of money to be made in the successful convergence here for the auditing firms. So, I mean, they've been on board. I think that they believe that this matters as well, but they've been on board with IWA since day one, in part because they see this as a necessary tool that needs to be audited. But again, I think an impediment is that we have several really passionate organizations who are doing it well and doing it similarly. And I mean, fortunately, as an academic, I don't have to get involved in that part of it. I'll let Mario answer that part. But I do believe that convergence is a really important part of it.
Yeah, and I think, at least from the VBA perspective, the thing that we think connects kind of the impacts with business value is through company evaluation. So we've been working with a number of the large financial institutions, and what we're finding is, it doesn't work unless you drop down into a sector. But once you start looking at sectors, it becomes very clear that the market is paying a premium for those. So if you kind of draw a benchmark, you know, the market seems to be paying a premium for those that are, you know, good performers on social, environmental, on all those fronts. And those that aren't, the market discounts. Even in cases where they produce almost homogeneous products. So I think that's what we're trying to kind of drill down into, to understand what's the mechanism for all of that. How does it work? So that we can be a bit more precise in how we value the premium or the discount. And our view is we don't need to reinvent a whole lot of tools. You know, financial models still work. It's the information that goes into them. Yeah, we don't have to throw all those textbooks out on corporate finance. It's really just opening the aperture and taking in more information.
Thank you so much. So this is I am so proud because this is our business, to reinvent the way to represent business through numbers, to value for ordinary operations, for financial statements, for business valuation. So this is our business. I'm so proud because we are in a wide, broader debate in which many people, many scholars are investigating the behavior and establishing the principles, the business model, the change, and so on. Here, the very challenge is how to give the presentation in financial terms for external and internal user. The very challenge that is still open. But at the same time, what you say, please don't worry about financial statements and accounting that can be evolved, but we have not to dismiss existing knowledge. Okay, so let's work together, and thank you so much for your support in this debate. Now I'm very brief for. There is a question.
Ethan, Mario, what distinguishes those firms who are prepared to make these changes from those who do not want to make these changes? Can you just give us 2 or 3 factors that separate out these firms?
Yeah, sure. So we see more innovation. So innovation in terms of production, so using less materials, you know, recycling, all of those things that you might kind of bundle together as a more efficient production process. So we see that. We see around risk, there's much better risk mitigation going on. And, you know, so there is expenditure on workforce, on R&D, on all these things that help companies to be more resilient to deal with the impacts of never-ending change. So that would be, I think, the kind of main things that, and I guess finally I would say the degree to which they've gone beyond just talking about ESG. So talking to one of our members last week, a very large pharmaceutical company, the Chief Sustainability Officer said to me, can we stop talking about ESG and just talk about doing business properly? You know, and I think that's kind of where we have to get to. As long as we keep kind of separating this into, well, you know, we do good business and then we try and catch up with trying to address impacts, it doesn't work. You know, this should come out of how we do business in a better way, and it shouldn't just be driven by, you know, doing the right thing or a moral imperative, or because those things tend not to be enough of a sustaining factor in capitalism. So.
And I'll give you a quick example. So in my course I teach, I my students read a chapter from Jonathan Haidt's book, The Righteous Mind, about the elephant and the rider, which basically argues that humans are driven by our emotions and we use our rationality to justify our emotional decisions. And we teach it in context with a case on Exxon from 2015, when Exxon was the only oil and gas company that wasn't writing down any of its reserves. At that time, they estimated that the market for EVs would be less than 1% still in 2030. And this is the most sophisticated oil and gas company in the world. They were so wrong on everything in 2015. And the idea, how we tie this together, is that it was just that elephant writ large. It's an organization that's very insular, that has been doing things very successfully one way for so long that they can't imagine that the world's going to change. And to give you a positive counter, Salesforce is a great example where Mark Benioff was approached, people were saying, you're paying women less than men. He didn't believe it, but they brought the data to him. They had this constructive conversation with him. He realized that he was wrong and he changed everything, and that did wonders for the company's recruitment.
I would like to understand a bit more. You mentioned, Ethan and Mario, about the logic and the importance, of course, of this step ahead. But you didn't mention too much, in my view, about the weaknesses and the methodological differences. Of course, it's a great relief to hear that you're going to collaborate, okay? So I feel my heart feels much better now, because I'm already imagining two different approaches conflicting. But now, can you elaborate a little bit more about, the weaknesses and the differences? In a sense, how much my heart can be happy tonight after,
I'll break your heart a little bit first. So my understanding is that we are, our methodologies are really similar. That's the encouraging part, but collaboration has been really hard. And so we are not at that step yet. That being said, again, we agree on most things here. And on the weaknesses, Janine and I were talking about this last night, valuation models. The DCF has been used for forever. And it's still, everybody hates it. Most of the value is in this long-term residual. And so my concern is that we're making all of these assumptions that we want to embed in something like the DCF, so we're making assumptions upon assumptions upon assumptions, and then throwing it into an infinite time, and that's going to be really problematic, and it's going to be a hard sell as well.
Okay, I stopped to work on this session, otherwise we cannot go.
Okay.
You have another...
We can talk over dinner.
No, 1 minute.
1 minute. 1 minute. Okay.
We have to decide, because at 6 o'clock.
So I think between the Value Balancing Alliance and the foundation, it's now a foundation. We started from different kind of starting points. So we now, I think as Ethan said, I totally agree, there's not that much difference in terms of the methodology, but it's the use of the methodology is slightly it's pointed in different directions. But one of the things that we have colleagues from the foundation visiting us this week in Frankfurt, and part of that conversation is to sit down and try and identify what's a common conceptual framework. So if we're talking about an impact measure, what characteristics should that impact measure have? So rather than doing this kind of comparison of my indicator is better than your indicator, we're trying to move, well, collectively, what do we see as the kind of key characteristics of these measures, and how do they need to be improved? And do we see those improvements as short-term, medium-term or long-term? So we're trying to move through a systematic approach, because I think this, comparing my definition with your definition doesn't take us very far.
So next year we're going to see the
yeah, we'll be joined at the hip.
We'll have the big announcement in Poland.
Yeah.
Okay, thank you so much.